Apple is launching a new high-yield savings account that will offer up to 4.5% annual returns. The news was so groundbreaking that Apple managed to raise $1 billion within 4 days. In this video, we will delve into why Apple decided to launch a savings account, how it can guarantee such high returns, and why this could truly transform Apple into the bank of the future. With $1 billion raised in just 4 days by Apple, let's take a step back and provide some context to this news within the current moment we are experiencing. As we have seen on various occasions, we are witnessing the fastest increase in interest rates ever recorded. It began in 2022, and there are still a couple of increases expected in 2023. While central banks such as the Federal Reserve have seen a vertical rise in interest rates, what hasn't increased is the interest rate on bank current accounts. When you deposit your savings with a bank, it becomes a liability for the bank, meaning you are lending them money. Consequently, in an ideal world, you should receive interest on the money you lend. However, this is not happening. From a banking perspective, banks are not offering their account holders interest rates that align with the interest rates available in the market, which have significantly increased in recent times. But the stronger banks currently allow themselves not to increase interest rates. Interest rates and fear within the banking sector have resulted in banks being drained of capital. And where does this capital go, since it cannot all be withdrawn and kept in current accounts? Companies move their money, and it goes into the money market, represented by the upward trending red line since May of last year. Therefore, Apple is launching a savings account at the best possible time, in a context where capital is already leaving banks to seek returns elsewhere. The term money market refers to all those loans typically granted to nations, such as treasury bills with maturities of less than 12 months. These loans involve counterparty risk, and although there is credit risk involved, the duration is very short. Within the money market, there are also deposit accounts. But what are the banking mechanisms behind Apple's decision? Apple had already launched its credit card, which offered a 3% cashback, providing the opportunity to earn rewards by using the credit card. They had also introduced Apple Pay, allowing users to make payments with their phones by adding their cards to Apple Pay. However, a further step in Apple's transformation into a bank came with the introduction of Apple Pay Later, which allows users to pay for a purchase over time. Essentially, this means that Apple product users who make a purchase using Apple Pay can divide the payment into 4 installments, with 0 interest and no additional costs. Another important piece of Apple's strategy was the acquisition of Credit Kudos, a British startup specializing in digital financial services, particularly credit rating. This company analyzes customer data and creates a credit rating, evaluating the creditworthiness of Apple product users or users of Apple's payment services. Today, Apple is launching a deposit account that offers an annual return of 4.15%, 10 times the national average interest rate on current accounts, which hovers around 0.35%. There are no fees, no minimum deposit, and no minimum balance requirement, and it is covered by the FDIC, Federal Deposit Insurance Corporation, insurance protection for current accounts. What matters to customers is the trust they have in the Apple brand. In fact, these small steps are leading Apple to create an empire of financial services that will have a disruptive effect on the entire industry, shaking up traditional banks. With Apple Savings, Apple has formed a partnership with Goldman Sachs. But why is Apple able to guarantee such high returns? It does so because it has a secondary interest, which is to further bind its customers within the Apple ecosystem. To accomplish this, it offers a very attractive rate of return, perhaps by investing in a particular branch of business, thus further tying its customers to its product offerings and earning from other business sectors. In fact, to access this deposit account, one must have an Apple credit card, and to have an Apple credit card, one must have an iPhone. So, if you want this rate of return, you have to buy an iPhone, or if you already have an iPhone, well, if you want to maintain this rate of return, you certainly won't switch to another phone manufacturer. Therefore, it is a way to bind customers by clearly providing value, as you stay with me, and I give you value by offering more interest on your savings. But why hasn't Apple directly created a bank? Because the banking industry is very complex. governed by regulations, rules, information, and even banking failures. Apple, on its part, has tremendous credibility. Apple has a great focus on protecting customer data and has earned significant trust from its customers. However, perhaps it hasn't earned enough trust yet to take such a significant step as opening a bank. In fact, the phone, given the trust we have in this tool, is somewhat the key to being able to offer other types of services that all share a high level of trust the customer must have in the service provider and money management. Apple will surely consume the entire banking sector. It has the potential to achieve economies of scale that not even a large bank like Goldman Sachs can reach. So, during negotiations, Apple has said, you know what, we'll put our name and brand, and you provide the financial product, and we'll give you access to all Apple customers. We're talking about 1.2 billion iPhone users. This also makes even the largest bank in the world almost insignificant. In Apple stores, they estimate that in 10 years, Apple will have the same banking relevance as giants like Citigroup, JPMorgan Chase, or Wells Fargo, with future prospects that we can't even imagine yet. Hence, it's easily understandable why they managed to raise $1 billion in 4 days. For this reason, the CEO of JPMorgan, who had to rescue a struggling bank like Republic Bank, mentioned the risk of competition from American tech giants in his letter to shareholders. He specified that technology companies like Amazon, Apple, Facebook, and Google are investing significant capital in creating alternative products and services to traditional banking, essentially creating what is known as the bank of the new millennium. This is the evolution taking place in the entire banking sector, and Apple, slowly but steadily, like a glacier, is laying the foundation to create the bank of the future.
While you've reached the end of the video, if you are interested in learning more about similar topics, here you will find other really interesting videos from the channel. Thanks for watching this video. Click on the like button if you enjoyed it, and do not forget to subscribe in case you didn't. See you on the next one.